Joe Biden finally gives in to the pressure and quits the presidential race. The US dollar weakens. Stocks and bonds in the US and in Europe look positive this morning, but the technology sell off continues with a 3% drop in TSM shares in Taiwan today as investors' attention shifts to big technology earnings this week. So, welcome to the new week of trading with Swissquote's daily market talk. I guess no one was surprised to see Joe Biden throw in the towel and announce that he's quitting the presidential race this weekend. He endorsed Vice President Kamala Harris to take his place. Now, Harris said that she will do anything in her power to beat Donald Trump. She got the support from Bill and Hillary Clinton already, while Donald Trump said that Harris will be an easier bite for him than Joe Biden himself. Now, even though Biden's goodbye reshuffled the cards for the November presidential election in the US, it didn't materially change the expected outcome just yet. Because, well, we don't know if Kamala Harris could secure her party's nomination and gather enough momentum actually in the polls to beat Donald Trump. The early polls actually show that Harris is a favorite to become the new Democrat nominee. But that Donald Trump is still expected to win the November election. Now, the Trump trade could actually lose some steam on the news, but will probably and certainly not get reversed if Harris doesn't make a material difference in the polls quick enough. And well, the latter was reflected with a brief sell-off in Bitcoin just after the announcement that Joe Biden is quitting the presidential race on Sunday. But then the buyers just sent the price of a coin past the $68,000 mark, and we are just below this level this Monday morning. The US dollar, on the other hand, is slightly softer across the board. The US dollar index is offered near its 200-day moving average that stands near 104.40 level, and stock futures both in Europe and in the US are in the green at the time I'm talking here, while the treasuries show muted reaction with some small gains at the beginning of a new week after a cyber attack, which is actually nothing but the largest IT shortage of the world history, actually came on Friday as a cherry on top of a week that was marked by increasing worries about the AI spending and also worsening global trade relations in case of a Donald Trump victory in the US this November. Now, while Friday's digital worldwide chaos was not a hack, on the contrary, it was caused by an update from a cybersecurity firm called CrowdStrike that actually triggered an 11% sell-off of its shares. Well, it sure showed to what extent many systems around the world are concentrated in, well, the hands of just a few IT providers, and how bad the world could look and how seriously activity around the world could be paralyzed in case of a hack. So although the Friday's chaos came as a threat to CrowdStrike's reputation, well, it can only be a positive for the cybersecurity firm's valuation in the medium to long run, because we can't just go back to an undigitalized world. So no wonder competitor stocks like Palo Alto Networks and SentinelOne rose significantly on Friday on CrowdStrike's misery. But the week started looking unappetizing in Asia. Equities in Australia and in China fell, for example, and that despite a surprise interest rate cut announcement from the People's Bank of China at the start of this week. So the Chinese central bank pulled its interest rates to new record lows to boost economic growth and give support to the troubled property sector in China. Then the President Xi Jinping actually revealed plans to improve the finances of the highly indebted Chinese local governments, but in vain. Last week's Communist Party gathering in China, well, didn't bring big changes to their policies. There was no news of fresh stimulus, for example, so investors didn't really want to extend their exposure to Chinese equities this Monday morning. The CSI 300 index is being offered near its 50-day moving average this Monday, erasing a part of last week's gains that were built actually on hope that, well, we would hear at least some stimulus measures from the government to make a difference for the Chinese growth and the subdued property sector there. So the week also started on a meager note for the technology stocks in Taiwan because TSM kicked off the new week with a 3% sell-off after last week erased more than 3.5% from the technology-heavy Nasdaq 100 index in the US. The S&P 500 fell nearly 2% over the week, while the Russell 2000 index printed a 1.5% advance, and that despite erasing more of the earlier gains on Friday's trading session. Now this week, the economic calendar will be light in the US. On Thursday, the US will reveal its latest GDP update for the second quarter, expected to show a rebound to 1.9% in the second quarter from 1.4% printed in the first quarter. Then the core PCE index, which is the Fed's favorite gauge of inflation, will tell us on Friday whether the price pressures in the US will further ease as economic growth slightly improve. And a better growth combined to softer inflation would obviously be the best possible outcome for the Federal Reserve and also for the Fed watchers, as it would mean that the Federal Reserve is getting closer to abating inflation in the US without sending the US economy into recession. So that should in theory echo positively across both stock and bond markets in the US, and could potentially, I say potentially, slow down the sell-off that we see in major indices today. But the earnings will probably certainly matter more this week than the economic data itself, as two of the Magnificent Seven companies in the US are due to report their second quarter earnings as soon as this week. So both Tesla and Google will be revealing how well they did in the second quarter as soon as this week. Now, Tesla is a story on its own, and we will obviously comment on Tesla's results in detail later this week. But Google's earnings will actually be very, very important for the interpretation of where the AI craze is going. Because remember, last earnings season, we were actually looking for whether the huge AI spending from big technology companies that actually profited to the providers of AI tools like semiconductors and data centers would start bearing their fruit for the holders of big data like Google and Meta, and eventually shift the AI rally from providers of AI tools to those who actually heavily invested in these tools. And the answer last quarter was no. On the contrary, Meta, for example, had announced that it needed to boost its AI spending more to reach a level of play that could turn into a significant profit. So again, this earnings season, investors will continue to chase any positive impact of big AI investments from big data holders like Google and Meta, for example, to see if the worries that these huge AI investments from these companies would, well, be as profitable as they should be, or they will not. And because no one really knows, well, the answer of these questions, we could either see the results from big technology companies this week lead to a further profit taking in big technology stocks or slow down the bleeding here. The risk this quarter is that even blowout results from companies like Nvidia may not keep the euphoria in AI going if those who heavily invested in these AI tools can't show their investors that there's still something worth keep investing in this technology. So this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.